MassMutual, one of the major mutuals, just put out a pretty harsh memo rebuking and being really hard on infinite banking. We're going to talk about the memo. We're going to talk about our initial thoughts, pros and cons. And to discuss this, I have Dom Rufren in the house. He heads up and leads everything life insurance at BetterWealth. And I know that you've been in the trenches and you've talked to different advisors that have hit us up. We, just in full disclosure, have a relationship with MassMutual. We have great friends at MassMutual. And I think we'll give our unedited feedback. I want to be very clear that we're not making any claims. Mass, if you're watching this, we don't want a lawsuit. You've been very great to us. But overall, I think you've drawn the line in the sand, and we're gonna talk about that, and we're gonna talk about the pros and cons of that.
Get a lawsuit from a company that has more money than most countries.
They have more. We're like, we will take down the video. We will. It's just deleted. No, with all joking aside, I think it's one of those, whether they thought it was going to leak or not, with the world that we're in, anytime you take a hard stand, it's been out there. There's so many videos reacting to it. And in the world that we're in, I mean, we'll be the first to say that we're not like raising our hands saying like we represent infinite banking, but we talk about life insurance, overfunding, the and asset. And so we're very much in those communities, and we've had many videos. You have a lot of videos on the and asset channel really going after the pros and cons of infinite banking. And some of the same things that we talk about are why Mass took this strong approach. And so we can unpack that. But why don't we go back to from square one? Who is Mass? Why is this like a big deal? And we won't say like how long we've worked with them, but like where has MassMutual been really good in the past and how have we used them?
Yeah, so MassMutual is an insurance company that has been around for over 170 years.
Wow.
So it's insane how long they've been around for. And they have so much money, which is why they're one of the 4 major mutuals, is because they have so much money backing them that it's like when I was saying at the beginning, they have more money than most countries. Like they do. And they even have enough money to put like $100 million into Bitcoin and things like that and still be just fine, is like the risky side of stuff. And so them being such a massive company and getting a news report / memo from a company like MassMutual is huge to the industry. And for us, we have used MassMutual in the past, and they have been great in regards to designing policies for high early cash value. I mean, they have a policy that's literally named high early cash value. So I really like MassMutual. I actually personally have my policy with MassMutual as well. And so when they came out with this memo, one, I actually was very empathetic to why they did it. I think from a business perspective, if I was in their shoes, I would have actually done the same exact thing. And I have very strong opinions around this. And so I'm actually really looking forward to diving in and talking about this, because I think there needs to be some change in industry. And I think that what MassMutual actually did was a wake-up sign for a lot of people.
One thing that we have to be empathetic on when you're looking at a MassMutual is they have 2 sides of the business. There's a broker side and then there's a career side. And Mass, along with some of the other major mutuals, have a massive career arm, meaning these are people that are actually employees of MassMutual, and they say they can represent other carriers, and they can, but they're highly incentivized to work with MassMutual. So Mass is dealing with the career arm, which is a huge arm for them. And then also they're working with brokers, and we would be considered brokers because we can write with Mass. We have access to the same policies with Mass, but since we're not committed fully to Mass, we quite frankly get paid less, but we would rather get paid less for the freedom. And so the Mass is a big company that's dealing with both sides. And so this memo went out to both, but I think mainly was going out to the people that they have more control over, if that's fair to say.
Yeah, and let me start by sharing where the problem actually arises. And I don't think there's anybody talking about this yet. And this is from me being into the weeds of like looking at policies over the last few years. So before 7702, when people would sell a MassMutual policy, they would sell the L100, right? It's essentially a policy that you have that you could pay to 100 years and it would perform fairly well. The cash value in that would probably be around 85%, first year, 80%. And that's if you talk about overfunding and fully maximizing the policy. Ever since their 7702 update, they had policy changes in regards to their contracts. There was new guarantees in regards to their L100. They had different guarantees in their 10 paid, new guarantees in their HEC-V, which is high early cash value. And people were not really selling high early cash value policies because they didn't get paid as well up front. And in regards to commission, you got like 1/5 of it, but they got spread out over time. So a lot of agents essentially shied away from that. But then for people that were the infinite banking space, right, that was kind of their go-to, the L100. But when the new 7702 7702 update happened, when you started looking at the illustrations did not look very good at all. Policies were breaking even later. You had less cash value earlier on, but people really liked MassMutual still. And so what did they do? They started pivoting into the HEC V because it was the only policy that actually made sense. And what the HEC V did is it started giving people the ability to have access to 92, 93, 94% of their cash value early on. And so this HEC V was essentially MassMutual's way of writing BOLI contracts and COLI contracts and huge contracts with these major businesses. And that's what the HEC V was created for. So these businesses could have high liquidity on their balance sheets to essentially show for business purposes, for asset purposes. And what ended up happening was the consumer ended up starting to move into that world of the HEC V, and including us. Like, we started selling HEC Vs and moved away from the L100s because I started looking at the contracts and I was like, this doesn't make any sense. Like, I have more cash value short-term and long-term. And that was the big difference that like blew my mind, was that the L100 in the past wouldn't have as much cash value first, but it would always pass the HEC V at some point in time. So then you started getting a product like the HEC V that had more cash value first and more cash value later on. And the loan rate was also lower on the HEC V than it was the L100. So the L100 essentially became a dud of a policy when it came to the infinite banking world, and everybody positioned out of the HEC V, which provided more cash value, which pushed people to that, which then created this whole entire movement around this one product, which I think has started the foundation of the problems that were created.
I've never heard anyone else talk about that, and that's powerful and very interesting insight, because a lot of insurance companies have always had a problem with people using the word bank. They don't like that. They don't want you like, there's a lot of regulations around a bank. There's also a lot of people that are just teaching infinite banking wrong. They're super salesy. They're scammy. Their math doesn't add up. They're telling people, put all your money into your life insurance, which is a huge red flag. And then they're also telling you to like use it like a checking account. And like, insurance companies, I don't care what insurance company you're at, does not want to be a actual bank account for you. And that's this could be a whole nother video, but that could be another reason why you should even use a third party lender, a place to borrow against your policy instead of the insurance company, mainly because of that same reason. Is insurance companies are not set up to be like super transactional. And so I think you had that perfect storm of what you talked about, interest rates, where it's like not necessarily super advantageous for insurance companies to want to have outstanding loans, cash flow. But then also, now that with the TikToks of the world, you can have videos that go viral, and all these people are thinking about their insurance as an actual like checking account. And you have something like company like MassMutual that's like, what is going on? And that could all hit the fan. And then that's where they came very, very strongly and said, hey, we're not endorsing. If anyone's talking about you being your own banker or infinite banking, I mean, they've essentially created like a cease and desist order from a standpoint of like, they could terminate us. They could terminate other people if they think like we're heavily selling infinite banking. They kind of drew the line in the sand, but I think they're not anti-overfunding whole life and utilizing it as an and asset throughout your life. I think they're anti-overfunding and then using it like a bank account and being super aggressive. And we've kind of known that. And we've, for a while, like many years in the making, have told people, if you want to use your policy a ton, especially early on, MassMutual, while they're super competitive and they're a great company and they're awesome, they've been really clear with us. So like, hey, that's the kind of business we don't necessarily want.
Yeah, let me talk to you from a technical standpoint on a business side of why MassMutual would want to push away for this type of policy or this type of demographic. So when you start looking at the numbers, right, I've heard at one point that the industry average was life insurance companies in general, 6% of their entire book was loaned out. Okay. Personally, I know that Penn Mutual is currently at 4% of their entire block of book of business is being loaned out. MassMutual currently has 12% of their entire book of business that is loaned out. That's a massive amount in regards to a company that is a behemoth of a company. So you can imagine how many policies and how much money that is outstanding on that balance sheet. And if that is the case, that means 12% of their entire dollars that they can essentially go use to deploy other places is now being tied up and controlled at whatever rate they're borrowing from the person. So if I'm the insurance company and Caleb is the policyholder and he borrows money out of my essentially bank account, which is the general account of the insurance company, well, now that's leaving my account because I'm now loaning money to Caleb. Caleb can go do whatever he wants with. He can go be his own banker, so on and so forth. But now I am charging Caleb only 5.7%. right? So I'm earning 5.7% because I lent that out to Caleb. But the problem with that is there's other opportunities over here where I can go get 8, 9, 10% that I'm missing out on because I'm lending my money out to Caleb. So I am losing that essentially lost opportunity cost of what I can go do with it. And on the other side of things, when you start looking at anytime somebody takes a loan out, there is an actual transaction that takes place with that. It's either could be a tech, it could be a person, it could be someone verifying, there's documents, there's a cost of doing business when it comes to taking policy loans out as well. So it just adds another cost to these individuals when you start looking at the business as a whole. And the third thing that I want to point out is you have a lot higher risk of policies lapsing when you're looking at it from a standpoint of like being your own banker style policies, because people are constantly leveraging and using their dollars. And if they're not using it in a appropriate professional way where they understand how leverage works, well, their policy can lapse by not being able to pay the premiums, or their interest becomes higher than their cash value. And when that happens, the insurance company you would think would make money because the policy's done and over with. But these insurance companies, when you look at their operating costs and all things being said, they really don't become profitable until an insurance contract is in place for around 13 years. So there's a lot of pieces that are involved with that. And so if I'm MassMutual and I'm where they're at and I'm a behemoth of a company, I'm going to be just fine by saying, hey, I don't want the infinite banking, IBC, be on your own bank type of style, because we have tons of other opportunities and businesses otherwhere that are going to do just fine.
That was really, really well said. And Dom doesn't have any notes. So just letting you know, this is all coming from his mind. Last thing I will say there is cash flow too, is if you have 12% of your portfolio and you're loaning it out, again, this is not just for infinite banking, because there's no way there's 12% of the portfolio being infinite banking. A lot of these people are in retirement taking loans. And what that essentially means is MassMutual is not going to get any cash flow from 12% of their portfolio until these people die via the death benefit. And so while insurance companies are the best companies positioned for interest rate and hedging your mortality and really hedging both sides, when your portfolio is getting up there, that's another thing from a standpoint of like a benefit that we preach, like you unstructured loan payments, you don't have to pay the insurance company back. That can actually be a disadvantage if too much of your assets are tied up in something that you're not getting cash flow back, because they're on the hook for, you know, death benefits and paying dividends. And I want to be very, very clear. Like these companies have so much money, so much reserves. They're just fine. I think it has a lot to do with what you said. And I also think they just want to make sure that they don't get sued in people selling life insurance the wrong way. And I think that was a big thing when I read the memo. I was just like, okay, very, very clear in like sales language. And they really drew the line and were like, we do not like this. We do not endorse this. And so it's just something, whether you're an advisor, an agent, I think we are at you very empathetic and probably agree more with Mass than you think. But I think it's also very, very, very important. If you have a platform, if you're writing a book, if you're speaking, you have a moral obligation to speak the right way and share the right things and not be super aggressive. Because if you are, you're not just affecting yourself in the long run, and you're not only going to get lawsuits yourself in the long run, but you're actually affecting a lot of other people. And the people that were super aggressive, both on the whole life and the IUL side, are responsible for these memos, even though no one was named. I think infinite banking, R. Nelson Nash, the movement, is an amazing movement. And like every movement, as it grows, you have very interesting people that can be a part of that. And the same thing with actually Pamela Yellen and her movement of becoming your own banker was actually what could have got this thing sparked as well, because they've done a ton of marketing behind her name and behind her book. And there's a lot of people that are not even a part of the institute that is, you know, going wild with it.
Yeah, I just think at the end of the day, if you're a consumer watching, understand the product, understand the company, understand the person you're working with, understand how you plan to use the product, and making sure that you understand that if you get into this space, that it's actually life insurance, that you're not signing something that you thought was an investment or saw was some fancy magical bullet. But at the end of the day, it is whole life insurance. If you wanted whole life insurance, that's what you actually got, right? It wasn't potentially like an IUL or UL or something along those lines, of variable UL. Just really understand what it is, the goal and the objective, because we are firm believers that not everybody should have this concept of overfunded whole life insurance, especially if you're somebody who doesn't have a ton of income. And, you know, when people are starting some of these smaller policies, they also become a greater risk as well. And MassMutual is very clear that they wanted to push away from those types of smaller policies, bigger risk people. So again, if somebody's a business owner, an entrepreneur, and they're doing bigger size policies. They understand how the concept works and they're getting into life insurance. They understand leverage and when to use it in the right time. I think it can make a lot of sense to still write business with a company like MassMutual. Like, I don't see why that wouldn't be the case. It's not by any means saying MassMutual doesn't want any business at all. And that's not saying that we're going to stop writing with MassMutual either. It's just essentially saying, look at the bigger picture and say, okay, like what's really going on underneath the hood.
Yep. I think with that, if you want to learn more about the and asset, how we structure life insurance, there'll be a link down below. It's called our and asset vault. We have just information on what is the and asset, a 6-part video series, a handbook, and so much more. You can even talk to someone on our team that can help, customize your numbers with where you want to go. And again, we always thank you for the comments, for sharing. We appreciate you. This is why we do what we do. Is like, if no one watched these videos, we would not be sitting here talking. So the fact that you listen, we are incredibly grateful. And with that, have a great rest of your day.